How you doing? This is David W. Williams, also known as Diamond Dave. Let me know you can hear me. The audio's coming through. What we're going to talk about is how I use the FOC meeting to profit a few thousand. So this was going to be a short-term play, something not something that I normally do, but something that was appropriate for the situation, kind of based on my trading plan and something that I had been observing for a good amount of time, right? And what I want people to really understand is that there's a lot of opportunity in this market once you start to see it the right way and you're able to put the time into it to actually make it happen for yourself. And one of the things I try to get people to understand is I always ask them, if you wanted to make like $10,000 over the next 90 days in the market, what would you be willing to do to make that 10,000? Right? And that's kind of like the question you want to ask. And I don't mean like, what would you be able to do? I mean, like, how much time would you be willing to put in to determine what is going to put you in the best situation to make that money, right? What study would you be willing to do? What strategy would you be willing to come up with? Because what we can happen to us is that we can think somebody else is going to give us the keys to the temple, right? And sometimes you got to find that key within yourself based on what somebody's taught you. And then that key opens up every door. But often we want somebody to not only give us keys to the temple, but we want somebody to walk us into the temple too. And that can sometimes be challenging for a lot of people. And I often think maybe that's why people don't have success. But what we're going to do is break down this play really, really quickly and give you an understanding of the possibilities in the market. Because once you believe that you're a trader, you'll start to see the opportunity in everything. It's just, are you in a position to trade it, right? And this is something I had been looking at for a very, very long time because I didn't even know people that traded the SPY. Then we had people that came through my program and they started trading the SPY, and it made me understand that, okay, the SPY can be traded. I came up trading individualized tickers, right? And so I didn't even have any idea at all how to trade the indexes. Had no idea. I traded one ETF, which was GLD. That was it. And GLD doesn't move like the SPY, the QQQ, and any of those other things. Didn't trade any of the leverage indexes, none of that. I just looked at, because I came out of doing fundamental analysis 100%, I always looked at companies. Then through my program, we started producing people that were successful trading the SPY and the QQQ. So then that created the idea in my head that it could be done. And often we don't think something could be done because we don't see somebody that resembles us or models us that does it. So I am a fan of representation, but I'm not a fan of living vicariously through somebody else. So what I didn't do was I didn't just say, okay, it's good that this person does it. I spoke to that person about it. They gave me some basic understanding. One of the people that does trade the SPY, her understanding of it is in the VIP course based on how she trades the SPY. And then I started applying myself in this particular area. Also took classes from Chastity on the SPY, right? Then I have another person, Mr. I think his last name is Downer, first name is Thomas. He also showed me some stuff with the indexes based on what he did. So one thing about me is that I'm not an information junkie by any stretch of the imagination. I learn 2 or 3 things and I try to stick to that and try to just essentially get better and better at those 2 or 3 things. What I don't do is try to figure out 100 ways to do something, right? So do I continue to expand my tool set? Yes. But what I try to do is say, hey, I'm going to learn from this person and this person, and I'm going to integrate what I do into it, and then I'm going to build up off of that as opposed to trying to learn everything. But really quick, let's get into the play because I don't want to be long-winded because this isn't one of those live streams where I do like a 50-minute monologue and then I start talking about the content. So first off, let me put my banner up. So we want to first, this is what we call event-based trading. Now, many people, especially in this space, they don't really understand event-based trading because they just taught technical trading. And I'm not against technical trading, but I am a proponent of event-based trading. Right. And many people don't really understand what event-based trading is. They think they do. But if they can't do it, then in my opinion, they don't really understand it. So to me, once you kind of get a basic understanding of what it is, then you can try to deploy it and you'll get a better understanding of it, because pretty much like all real estate transactions are event-based. Like to me, the whole real estate market is event-based trading, in my opinion. Right. A lot of the car market to me is event-based trading. Right. And so what I want people to understand is that this is going on around you all the time, but you just may not be aware of it. So what we're going to do is we're going to watch a really quick video on what event-based trading is. It's not going to be specific to what I did, but it's going to give you a basic understanding of what it is. And then we're going to start to specifically talk about what I did individually and kind of walk you through the process. And then you can maybe try to take it and replicate it in your own trading plan or whatever you may do to trade. So let's go and get into this video real quick.
I'm Paul Schultz. I'm the John and Maud Clark Professor of Finance at the University of Notre Dame and the Director of the Center for the Study of Financial Regulation at the University of Notre Dame. Some hedge funds use what are referred to as event-driven strategies to attempt to profit from uncertainty about the success of a corporate event like a merger, acquisition, or bankruptcy. For example, when a company attempts to buy another company, it does so at a premium to the prior price. As long as there's uncertainty about whether the acquisition will be completed, the market price of the target firm will be below the proposed buyout price. So, for example, stock XYZ could trade for $30 a share. Another company announces they would like to buy the entire XYZ company for $50 per share. The price of XYZ is likely to increase to some value between $30 a share and $50 a share. A hedge fund that is engaged in event-driven investing will study the antitrust issues and other things that could prevent the merger from going through. If they come to the conclusion the market underestimates the likelihood to take place, I shares XYZ. Merger completion, it will sell as a short to profit from the decline in price.
Okay, so that's just a basic understanding of like an event-based strategy. It's not specific to what I did, but it just gives you an understanding of how some people, some funds in this particular situation trade based on an event as opposed to trading based on a technical pattern. Now, many people are fine trading based on technical patterns and they just exclude any fundamental events in the scenario, right? And that's cool if that's what works for them. However, this was an event-based scenario that I incorporated some technicals into it. So let's go ahead and break this down real quick, right? So first thing I asked myself is like, what is the macro situation? Okay. And I think that's important because what I think a lot of people do, and it's not their fault, sometimes it's how they're brought into the market, is they exclude the macro situation in every scenario. And it's because they may not have been exposed to it. They can't talk it. They exclude the macro situation. So one of the things I teach in my VIP courses, I teach people look macro, look sector, industry, then look company, then look management. Now with the index, we don't have to worry about company and management. We definitely don't have to worry about sometimes sector or industry, but we definitely got to worry about the macroeconomic situation. So the first thing you want to ask yourself is, what is the macro? So the first thing I did in this scenario, before I made a trade, I said, what is the macroeconomic situation? Well, we know what the macroeconomic situation is, especially if you follow this channel. We're in a quantitative tightening cycle, right? We're in a quantitative tightening cycle. So the Federal Reserve is raising the rate and they're supposed to be unloading their balance sheet. So we're in a quantitative tightening cycle. I've never traded in a quantitative tightening cycle. Every time I traded before this particular cycle, we were in a quantitative easing cycle. Also, what's the macroeconomic situation? There's a war in the East. What's the macroeconomic situation? Inflation's really, really high, right? Relative to 2%. What's another macroeconomic situation? The bond market is factoring in a recession in the near future. So these are the macroeconomic situations that can impact, right, what is going on in the overall index, because the index represents these particular 500 companies in the S&P 500, and the ETF of that is a spot. So I always ask myself, what's the macroeconomic situation that's going on first? And I use it as a foundation to build off of what else I'm doing, okay? Second thing, what is the market sentiment? Okay. And we know that we're in an environment to where the market has been bearish for so long, people are looking for any reason to be bullish for a lot of different reasons. And many people are trying to create a narrative that the Federal Reserve is going to turn policy. So some of y'all may not be aware of, there's this guy, and he was at this FOMC meeting. His first name is Nick. I think he's of Greek heritage. And he writes for the Wall Street Journal. He's quote unquote called a Fed whisperer. He put out an article maybe 2 weeks before last Friday that they were going to pause or stop rate raises in December. As a result, the market rallied. And we've seen this to where every rally, they start creating this narrative that, well, it means that the market has reversed itself. Now, that's not coming from the Fed, but that's coming from the financial media. Because like I said before, is that most people make their money being long the market. So they're negative this year. And we're going to talk about something later on. They're worried about their clients' perception of the market because most funds are negative on the year, and they're really negative. They're negative like over 10%, right? Which is a lot. You know, if you put $1 million in a fund and over the course of a year, you lose 10%. Let's just say you start off with $1 million at the top of the year, you're now sitting at $900,000. That's a big piece of your asset that you lost 10% over. That's a lot to lose over the course of a year, right? Because most funds wouldn't gain 10% over a year. So you lose it can be hard. And most funds are over 10% at a loss, right? So the market sentiment is we want this policy reversed so we can run it. We also see that from Cathie Wood. Elon Musk said the same thing on his Tesla earnings call. Everybody's hurting now because they can't benefit in this market. Now the liquidity's tight. They can't benefit. And they only look good in a certain market. And that opens up a bigger door that a lot of people not ready to walk into. I am, because I've known this about this system for a very long time. But because of the indoctrination, because of the socialization, most people can't really see what they're looking at, right? But I can see straight through it. I know how this thing was built, and it wasn't built based on things actually being true or accurate. It's based on we can create a narrative and we can enforce a narrative. So then therefore it's true because we say so, right? So then what has happened in the past based on technicals? So this is why I bring the technicals in. Looking at the SPY, based on the FOMC meeting, what has happened in the past based on technicals? And what I was able to do with the help of somebody else, we charted out literally the last 20 FOMC meetings. And we found that 19 of the 20 FOMC meetings, the same thing happened, right? That's what we found out. Once we realized that, we said we got them. We got them right where we want them. So if this stays true to this trend, we got them right where we want them. Now, there's no guarantee it's going to stay true to it, but we've identified something. Then what we did was we back tested it, right? So I don't know if that's the next thing that I talked about. Okay, so my bad. Could I chart the action on my own? So once I seen this trend and this pattern based on FOMC meetings, then the question is now go into a chart. Can I chart it on my own? And what I mean by that is that based on the FOMC meeting, can I see it on my own? Right? Do I determine how I'm going to enter and exit this play based on my perception of it on the chart? So what we realize is that on the day of the FOMC meeting, there's a specific type of price action. And all you got to do is play it based on the price action. It's real simple. So once we were able to identify the price action based on the FOMC meeting, we were able to play it based on the price action. We found out that this price action took place regardless of the macroeconomic situation and regardless of that. So even though the other times it happened, it was because we were in a quantitative easing cycle, we still had the same chart action based on the FOMC situation. So what happens is, and this is where a lot of people get confused, these hedge funds program a lot of algorithms. And the algorithms are programmed to trade either based on action or not action. And therefore, a lot of times now these programs are traded based on triggers. People say words and they trade based on the words. And once you start to really understand that, you can start to see how these algos trade based on people speaking that's event-based. And the FOMC meeting is a big event. And they train algos to trade based on that event. And once you understand that, you can actually start to see this being replicated on the day of the event and on the charts, right? So once we identified that, we saw it enough times, I was able to find it on the chart, then we just back tested it. So I watched during several meetings this same scenario happened. So I was able to actually show it that, okay, it's just not a theory. I'm actually looking at this meeting and I'm watching this chart actually repeat itself. Then I watched it in another meeting. I watched the same chart actually repeat itself. This meeting, I said, I'm going to go ahead and take the play. And if you notice during the FOMC meeting, the algos would trade a certain way. And then once they get to a certain level, they start to consolidate, they always go opposite. So once you see that, then you know what you need to do. Now, what you have to do is you got to be able to be disciplined with your entry and your exit. And that's what a lot of people mess up as options traders, because they buy, too far out of the money. I bought this play very much in the money, right? With a little bit of time. I didn't buy a same day expiration. I think I bought a 2 or 3 day out. So that's what your understanding of how to actually work the options change work. But what you'll notice is that the way the algos are programmed and the way market sentiment is set up, they'll start off with a certain pattern, they'll consolidate, then the pattern just reverses itself. And it does this over and over again for every FOMC meeting. Don't mean it's going to do it next time. It mean it did it this time and it did it 19 other times before this one. Right? And that's what you have to understand. So then once I was able to determine that, I was able to back test it. I know somebody else in my particular course, they were playing this before me, but I don't know if they're operating on the same strategy because, everybody trades different. But I knew that people were taking this play. I just didn't know how to take it. So I got with another person and we sat down and figured out, like, how can we continue to research and research and research? So it took hours of research to figure out how to run this play. But once I figured it out, I made more money running the play than most people going to make working that week. And then I can continue to make money off this play, and I can take this particular strategy and I can apply it to different scenarios over and over and over again, because there's a million event-based scenarios that algos trigger off of in this particular market. And so what I would want to look for, is there a pattern to this, right? And then also, what is the macroeconomic situation? Then what is the market sentiment? Because often what you'll see is that algos will go opposite of market sentiment. What they do is they allow a lot of people to take a position based on sentiment. And then a lot of times what they do is once those position hits a certain trigger, they just go opposite of the sentiment. So that's why you got to be wary if everybody's on the same side of the trade. That could be very dangerous in this market. Now, 2 years ago, everybody was on the bullish side. But now it's what we've seen over the past year is once everybody gets on the same side of the trade, a lot of times it goes opposite of that. And that's what the market is doing, is it's baiting people in. Everybody goes to one side of the trade, and then the algos trade is separate, and it wipes those people out, and then it starts all over again. They've been doing that all year, and people just keep falling for it because most people don't know how to make money in this market if it's not going up. They don't have any idea. Then they buy puts when everybody else buys puts. You know what a good time to buy puts was? Today. That's not investment advice. And I'm going to talk about that a little bit. This was a great day to buy puts. Why? The VIX was low, so puts were inexpensive. What are most people going to do? They're going to wait till the market sells off again, and everybody's going to run into puts. You know what they're going to do? They're going to drive the market right back up. Until they get ready to collapse the market and we get capitulation, they're going to just keep doing this thing over again. Why? Because they make money doing this. And that's what people don't understand. They make money doing these cycles. So the little bit of money I made is nothing, because they made millions, because I wasn't the only people playing this. So other people on this same play made millions. I just made a few thousand. And that's because most people don't know how to analyze the market on their own. They're waiting for somebody else to tell them what the market is. That's not how this game is played, right? In my opinion, you need to get a basic fundamental education. Then you need to go out on your own and you need to test what you think your analysis is. And you need to keep doing that and keep doing that and keep doing that until you get comfortable creating your own analysis, right? As opposed to, well, this person said this, well, that means what it means. It don't necessarily mean that, right? So that's pretty much going to be the topic. It's really not that deep. It's really a very, very simple play. Want to give you a heads up that we're still having our 20% off sale on the highestpaid.online. That's going to be for the VIP course, 20% discount. This price will be going up in the fall. The price of the core course will be going up in the fall. You will get another discount after this one, but it's not going to be at the same discount price. Many people will say, well, why is it priced at this particular level? Because in our opinion, the price is lower than the value of the course. We look at comparable courses in this market. For what I'm giving on the VIP course, they're priced at around $5,000 and going up. And many of them don't give you any one-on-one time. They don't give you any consultative time. The person just sells you a course and they keep on going, right? So what I'm trying to do is continue to curate and attract an audience of people that are really serious about getting money out of this market. They're not playing no games with this stuff, because that's what I'm trying to do, right? And then once we can continue to do that, then we can build up on that. And not only can we hit it in the options market, we can hit it in every market. Because like I said, I talked to GC, he heavy in the crypto market, right? But so he give me game on the crypto market. I don't know, because I'm not really in that market like that. So what I try to do is curate an audience of people that are really trying to get money out of these markets and continue to build up and build out, and they're serious about it, right? So that's going to be the offer. We got any questions, we're going to get up on out of here, because like I say, we ain't going to be here long. Let me get to this. Let me get rid of that. Let me get rid of that. Let me go back here. So if you got any questions, hit me up, and then we're going to bounce out. So Gregory says, how many hours of research did it take you to make this play work? I would say over 25 hours of research. I say over 25, right? And it was just really a lot of looking at a lot of charts. Spent a lot of time looking at a lot of charts of the SPY, right? In the FOMC. So what you can do with Yahoo, you can probably do with any charter, is you can break down to that day. And there's certain patterns of trading the day of the FOMC, because the algos are trading it based on the event. And once you learn how they trade it, you see it is right there, right in front of you. And that's for a lot of events. The algos used to trade based on Trump. That's one of the reasons why Mecca told me she started trading the SPY. Not trying to put a business in the street, but one of the things she talked about was that the market was so volatile because of the algos trading because of Trump. She decided that the SPY might be a better situation for her than trading the companies. Well, I was still trading the companies. So it was her trading the SPY that made me realize that was even possible, because I didn't know anybody that was trading the SPY. I think Lance might have traded the SPX. I can't trade the SPX because the contract is too expensive. But I can trade the SPY because the contracts are nowhere near as expensive. A lot of volume, options chains are really, really robust, right? So that's what I want people to really understand, is that I learned this and learned about the possibility from other people doing it. And then I just had to try to figure out how to make it work for me, because everybody's going to trade different. Because even though this is the SPY, this is really a technical play. There's a lot of fundamental analysis I do in the play, right? I just don't trade technicals. I just look at price action. I don't really look at anything else, and support and resistance. Ramon, man, I appreciate the $10. So Greg said that's $160 an hour. Yeah, that's about what I charge on the consult. So that's a good deal. So Ty says, got to keep studying market sentiment, watching stock and prices. It's confusing to remember the psychology behind it. Yeah, definitely. And there's a lot of reasons why a company could move up after earnings. Sometimes it's because the earnings are not as bad as people expected. It could also sometimes be where that company has been trading historically. A lot of these companies are so beat down now that any good news will move them up. But then with other companies, we saw with Facebook a few weeks ago, even though they had been beaten down, they got beat down some more, right? So it's all really case by case, right? It's all really case by case in my opinion. So Prime says, you bought some puts today. I feel you. GC says they don't say how the market works. Yeah. A lot of people don't really understand how the market works. I'm not saying I'm a market expert, but I think I got a better understanding than the average person. You know, people thinking that Carvana's a buy. I don't know what they're looking at, but it's their money. So Prime says, you think the SPY will be 320 in the next few months? Let's see how it plays out. It went crazy today. I mean, the NASDAQ was over 5%. It was crazy. I thought it was going to hit a resistance point and come down. It didn't. We'll see how it opens up tomorrow. Tomorrow, the bond market is closed, so we might not get a lot of volume. Romel says, I don't do enough homework on CPI. Expected a bearish reading. Today's report played against my position. Took a negative 14 out of stop loss. Well, I mean, I'm going to talk about in another video today what I think happened. I don't think it was you. See what I'm saying? I don't think it was your fault, right? I don't think it was your fault. And I think, you know, I may be able to help you get a better understanding of it. I don't really think it's your fault. I don't think anybody that was bearish did anything wrong. I just think what happened. And sometimes that's going to happen in the market. But I don't think it was your fault, in my opinion. I just don't. But I'll talk about that in another video. Let's see. I don't know what they're talking about there. Terrence, man, I appreciate the $9 super chat. So the market went crazy. I wouldn't trust it. GC says, I thought the 7% would be bearish. It is what it is. Yeah. I mean, it should be, because it's still 7% CPI. Energy costs are sky high, and they're probably going to get higher as we go into the new year, and they'll definitely get higher if China opens up their market. So we're getting a break because the Chinese, with them closing off with the zero COVID policy, are not demanding as much energy as they could be. Once they open that economy back up, if we still have these issues with energy in the East, energy price is going to go crazy, right? So I don't see why people would be bullish, knowing that that's very much a possibility. To me, the likelihood of that is higher of it happening than it not happening. Because all China got to say is that, well, we're going to open up our market. They're going to run it up because the Chinese market is open up. Well, people got to realize that they're going to use up more energy, right? And energy already is at a higher price. And Biden may not be able to convince the Saudis to pump more energy, because there's a lot of, conflicting, I don't know what you want to call it, agendas going on here, right? Between the Biden administration, the Saudi administration, the Russians, and the Chinese. So he may not be able to convince them to pump more energy. So as a result, it's going to make the energy price start to go up, because there's going to be a more demand on energy worldwide. So the speculators are going to drive up the futures price. So you'll start seeing higher inflation as a result of that. But market sentiment, and we have a market to where the majority of our participants can only make money when the market goes up. So they need the market to go up. They need to look good to their clients. You gain 8%, 9%, 10% this year, because they're just doing buy and hold strategies. So it's going to be rough, but we'll see how it plays out. Once we start getting deeper into the winter, especially in different parts of the world, because their winter really don't hit till after Thanksgiving. We start going into Christmas, and also really that New Year, that January, February, it's going to get real cold in a lot of different places of the world, and they got to figure out what they're going to do with their energy, right? Just they're trying to liquidate retail traders. I agree. But a lot of people don't understand that. They don't understand exit liquidity, right? Once they understand it, they'll see it, but they don't understand exit liquidity. Deshaun, I appreciate the $10, man. So Lamont says it's definitely a monetary policy versus a fiscal policy. I feel you. Mr. G, man, I appreciate the $10. Typical bear model rally. Yeah, that's what I saw too. Yeah, to me, this was nothing but a lot. When I'm looking at companies, and I'm going to talk about this in the next video, that are going bankrupt, like Carvana or Wayfair, that are getting ready to go bankrupt. They'll probably go bankrupt this year, and they're rallying up over 15 to 20%. That's short covering. Those are the shorts covering using algos, because there's no reason why people are buying this. There's no real demand on these tickers. There just can't be. I don't believe that. I don't believe that now people want Carvana at $15 to $16, and 3 days ago they wanted at $7. There's nothing that's changed about that company. These are the indicators that this is just a bear rally. It's a lot of short covering using a lot of algos, because what the shorts are doing now is they're selling it down. They're covering, which is smart. They're taking their money out of the market. They letting it run back up. They shorten it back down. They covering, taking it. So they've been doing this all year. And I don't think people see it, because the narrative is that the Fed's going to reverse, the market's going to go back up. Shorts have been killing it this year, because they've been shorting it down, taking their money out, shorting it down. They've been playing it real smart. Instead of them sitting in a short position long term or trying to slam the whole market down at one time, they just been bleeding everybody real slow. And it's been working. So I wouldn't stop either. So this bear market might go into next year, because what'll make people stop is if everybody just quits, and then the market will slam down real hard, and then they'll reset the market. But nobody wants to quit. They want to try to make this thing keep going. So the short's just going to keep drawing blood out of people. And I would do it too. As long as it keeps making money, I would keep doing it. And that's what we've been seeing all year. That's something that Chastity talked to me about. Because I thought this would be over maybe like summertime, but they keep doing it. So we ran up today. We might run up tomorrow. We might run up Monday. And then we'll see how long this lasts. Because you remember, I think in August, we have 4 green weeks. Then they slam the market right back down. Right? So they let everybody buy in, build that thing back up, and then they shorted it right back down. And they've been doing that all year, as opposed to slamming the whole market down at one time and making everybody quit. That means it'll be over real fast. And they're not doing that. They're going to keep making money doing what they're doing. So this is what I was telling somebody on Instagram. I say, if you look at a lot of these companies that are just terrible companies, like there's nothing there to the company, there's no reason AMC should be up 16% today. There's nothing there. Right? There's a lot of companies that we've already identified are really, they're zombie companies. They shouldn't be up 15, 20, 25%. Yeah, they just really shouldn't be. And that's what so when I see this across the board, and on the NASDAQ up almost 6%, almost 7% today, the interest rate and the strong dollar is going to continue to hammer NASDAQ companies. So why did all of a sudden it's up 7%? But like I said, if it's making money, keep doing it. I won't be convinced that this is a real rally until we're still bullish going into 2023. And I mean like maybe February. They can run this thing until next year. And in my opinion, the recession won't even start. I don't have the recession start until next year anyway. So we can run bullish the rest of the year. We just go to get our Santa Claus rally out of the way. Right? And then they wait until earnings next year to slam the market back down. And that'll give them enough time to push this thing back up so we can continue to short. Because as a person that likes to play the short side of the market, I don't like a company beat down, because there's no way for me to, there's no room in the middle. Because, as a short, you only can make money on the way to zero. Right? Once something gets beat down so low, the likelihood of you being able to make more money on it is lower. You want it to go back up. And these are the rallies that I wasn't understanding earlier this year. Right? Because what I should have did with Carvana was when they went back up to 50, I should have just bought bigger put positions. Right? But I was already in puts, so I didn't buy more. I should have bought more. When Carvana went up to 50, I should have bought more puts. But I was already in puts. So I said, I'm not going to continue to add onto my position. But that's what I should have done. Because then after their earnings that they had earlier this week, I think last week, they went all the way down to $7. So even with a higher IV, I still would have made a lot of money on those puts. But it was the shorts covering, letting retail come back in, buy it up, and they bring it right on back down. They took it down from, I want to say $30 all the way down to $7 before now they did a relief rally. So sometimes you got to see this stuff happen multiple times for you to really get that's what they're doing. But just like Mr. G said, there's no reason that Catherine would auction had those gains today. Exactly. These companies that she's in are terrible companies. What you didn't see was Tesla run up, right? You didn't see Tesla go crazy. It traded sideways. So, but you didn't see Tesla get north of 200. I think that's telling that they may be losing some of that enthusiasm around that company, because you didn't see a lot of short covering on Tesla. Tesla should have been up by 10, 15% today, like everybody else, and it really wasn't. Right? It had a decent day, but it didn't have the day that pretty much every other company had. And I look at a lot of really weak companies. They had great days. And I got a watch list of a lot of really, really badly managed companies. They had really great days today. The fundamental analysis around that company hasn't changed. But what we saw was those algos short covering everything, especially the NASDAQ in the SPY, especially the NASDAQ. NASDAQ went crazy today. But let's see how it does tomorrow. Like I said, the market's open, even though the bond market's going to be closed. Another thing you saw on the indexes is it moved up, but it started to trade not sideways, but we didn't get a parabolic move. Right? So even though it was up 7%, it was very gradual. That's a good example of a lot of algo selling. Right? You're not seeing people going above the ask in a relatively short amount of time. It's very, very gradual, because the computers know how to buy at a really gradual pace, because they got to figure out who to sell that to at a later date. So they don't want the stock to move too high, because they got to find some buyers, next week, week after, maybe even in December at those particular prices. Right? So Ramel says it's probably him. Yeah, we'll find out, I think, either tomorrow or next week if he's still selling. It'll come out. But he got to be selling to somebody, though. So my question is, why don't people want at a higher price? Right? So even though he's selling, somebody got to be buying it. And I don't believe based on the volume that it's him selling the market makers. So who has their buy conditions set at those prices to buy at those prices based on how they're looking at Tesla, right? But you see, like I said, it's not moving up higher and higher. It's pretty much, it traded in trade sideways, but it didn't get the run that it had that everybody else had. I mean, you had some companies go crazy today. I think Carvana, I look at Carvana, Wayfair. Let me see what else. GME, GameStop, AMC. These are zombie companies. All of them was pretty much over 10% on each individual ticker. That don't even make sense for those companies. You know, a lot of those companies getting ready to go out of business. They're cash burning. I think Beyond was up by 14%. They're cash burning. They're pivoting their whole business. There's no reason those companies should be up 14% in one day. That's a one-day move. Yeah, that's just, you got to know what you're looking at with that type of stuff. So we're going to get up on out of here. Go do another video a little later. But I appreciate everybody for coming through. Just want to really encourage you. Study like what you're doing and try to get a good understanding of it. And don't get caught up in the hype of the market. Because like I said, what we're seeing with the way they're shorting it is it's making them a lot of money following this process. So I don't think they're going to stop doing it till it doesn't make them any money anymore. And then if you can realize, okay, this is what I believe they're doing, you can either ride it up, like in August, we have 4 green weeks in August, or you can ride it down just by following the trend as opposed to trying to go against it. So if I see that the market is really bullish for the next few weeks, well, then I'll be bullish again. You know, I'm instead of me trying to be right, I'm going to try to make money. So if they want to run this thing bullish until the end of the year, I'm cool with that. Because like I said, I don't believe the recession is going to hit till like early spring 2023 anyway. Right? That's what I think is really going to hit. And I think it's going to be because of energy cost. And then if we get another FOMC meeting and they say, well, instead of doing 50, we're going to do 75, well, then we'll see the market slam down. We think we got another meeting in December. We also got, I think, one more CPI print, and I think we got one more PCE print. So if the PCE print comes in higher, we may see the market sell off, and it'll just be algo selling it. You know, because I was saying once the number comes in even or under, we saw that the algo's job was just to cover the shorts. Cover the shorts, get out, bring in retail liquidity, see where retail takes it, and then we can short them later on if they move the market back up. So if retail has a desire and the funds have a desire to buy this market up at these new prices, they'll definitely take those shorts and then short them back down either on a high CPI print, a high PCE print, or a higher than average or higher than normal rate raise, or language right around the rate that people believe to be bearish, because the guy already said, right, that they're not done raising the rate. So I would assume until they change that narrative or they change the rate raises, that they're going to continue to keep raising the rate. So if they go 0.50, I don't know what the federal funds rate will be. Then we got to see what they do in either January or February. But like I said, is that we've created a whole mechanism to where we only can make money if we keep driving this thing up. And so then everybody just has to play along with it. It's almost like a play where everybody got their role in it. The only one going against the script is the Fed, because everybody else is supposed to tell you the market's going to keep going up. Right? I think a firm was up today too. Firm is not in a great position. I think they were up over 10%. So everybody was up all across the board. Right? And so that's what I want. When you see this kind of stuff happening, you know this is not what it really is. I can get the index might be up, the NASDAQ might be up, but certain companies being down. When everybody's green, north of 10%, except maybe Tesla, you know, that this don't add up to the market that we've seen over the past year. Because the fundamental case is still the same. So you telling me now all of a sudden they found all these people that want to buy these stocks and buy these zombie companies at higher prices? Why would you want to buy Carvana at $15 when you could have got it Tuesday at $7? That don't even make any sense. Nothing's changed about Carvana. That's why I say you got to really start to not just to understand the technicals, but understand the fundamental analysis and also the macro analysis and also the market sentiment. People want this market to go green because that's the only way they're going to make money. Good Time says, how much time would you need to spend on your course a daily, weekly basis get started? So I tell people to read about the market 30 minutes a day. I don't know how you absorb information. What I would tell you to do is just figure out the goal on the core levels to get you to 2K a month. Ask yourself, how much time are you willing to spend to get to that number? Because it's not as if you have to be a slave to it, but like in anything in life, when you start off new, there has to be kind of like a front load process, right? When you got to kind of build out your skill set on the front load. So you may have to do more work on the front to build up the momentum that you got to do in the middle and the back end, similar to where most of the torque put on a car is going from 0 to 30, right? Because the car's stopped. Now we got to get momentum, right? So I would, in my situation, I would factor in a certain amount of time per day to study. And I wouldn't worry about that time. I would just worry about the consistency of that time. So if it's only going to be 30 minutes a day, I would just make sure I do 30 minutes a day every day. And I would just keep doing that over and over and over and over and over again. Right? Where people break down is where they stop doing the 30 minutes a day. That's where the breakdown is at. It's not like they break down to where I was doing 5 hours a day and then I quit. Most people break down on 30 minutes a day, just like working out. Work out 3 times a week. Most people break down just trying to get three workouts a weekend. They don't break down trying to work out 2 hours 7 times a week. They break down trying to work out an hour 3 times a week. That's where the breakdown is at. Breakdown is rarely at the extreme. It's normally at the level trying to build yourself up. So hopefully I answered that question. Let me know if I didn't. So appreciate everybody coming through. Didn't want to be here too long. Appreciate all the super chats. Want to just really tell everybody to make sure that they trade wisely. Make sure you manage your risk. Don't put yourself in a bad situation. So I don't want to see you get whipsawed in this market, because a lot of people bought puts on the close yesterday and they got whipsawed today. They lost a lot of money real fast, because I thought that SPY would hit, I want to say, was it 390? I thought it would hit 390 and sell off based on the resistance, and it didn't. Where was I at? Yeah, I thought it would hit, was it 390? Yeah, I thought it would hit 390 and sell off, and it didn't. It just kept moving up. So to me, just some really aggressive short covering with some buying, but it moved up higher than what I thought it would do, because I really thought initially it was going to close the gap down, but it didn't. It started catching some bids, and like I said, I just think that was short covering. So appreciate everybody for coming through. David W. Williams, the sale will be over. The 20% sale will be over on Sunday. So make sure that you get in, but if not, you'll be able to get in at a lower discount rate. It'll still be worth it, right?